Hi, everybody, and welcome to the Mint Asset Management market update for the single sector funds, looking at August, that Dave and I are here to talk you through as usual. I thought that these couple of slides would be quite interesting. I mean, basically everyone's talking about what happens in a recession and who benefits from rate cuts, and these two slides basically try and highlight who we think is likely to benefit. Clearly we're bottom-up stock pickers, so the sector stuff is helpful, but not a massive driver of our investment calls. But it is quite encouraging to see that our key sort of sectors that we invest in, such as healthcare and tech, seem to do pretty well at this stage in the cycle and going forward. The chart on the left is basically looking at the US over various cycles and highlighting which sectors perform. So if you're at the top and green, you're doing well. If you're at the bottom, you're doing badly. And generally, it's a decent proxy for what happens, but clearly all markets are different. And hence we've used the chart on the right, which basically looks at the Australian market and how it's fared. There are some parallels and similarities, and clearly, as I've just mentioned, healthcare seems to fare pretty well in both instances. On the chart on the right, you should be looking at sort of the third and fourth columns to see what's doing well and what during this time of the cycle. But overall, I mean, I think it's just helpful to have a look and see historically what's done well. Doesn't mean that things are going to do the same going forward, but good to know in every perspective. The only other point to note is obviously it's quite difficult to do this with the NZX 50, given there are a couple of sectors but not many, and it's mainly just sort of individual stocks, hence using the US and Australia to highlight the issues and how we expect things to go forward. With that, I'll pass over to Dave.
Thanks, John. So from a New Zealand market perspective, it was an interesting month. While we ended up just in the positive territory, it was a lot of a mixed result. We had reporting season, a lot of the major companies reporting. There were certainly a few surprises, a few misses. Now, I guess the top chart on the right there is indicative of what we saw. I think there's a lot of positivity since we've seen the RBNZ cut 25 basis points around what this means, and are we at an inflection point? But I think we got a bit of a reality check when you look at, as I said, the top right chart, which is misses versus beats, and there was predominant misses all round. There was a bit of a disappointment across the board. Now, I guess who performed well, who didn't. I mean, it was interesting to see the smaller end of town actually doing quite well in terms of performance for the month. And of course, in the falling rate environment, we certainly saw REITs outperform again, probably for the second month in a row, and they've had a strong outcome. And John will touch on that in a bit more detail later. But in terms of results themselves, I think, looking at the chart on the bottom right there, revenues, in general were not too far off. But as you went sort of further down the income statement and you look at sort of EBITDA and then EPS at the end, there's certainly a lot more misses. And that was through a combination of higher interest rates, also tax coming through as well. But just in general, there's not operating leverage there. In fact, there's deleveraging in a few companies we're seeing. And then the bottom two lines on that picture in the big bold red there is what analysts did to earnings for the next couple of years. And as you can see, there's a lot more downgrades than upgrades. So, the question is, are we at the bottom of the cycle across the board? And it does feel like we're getting very close to, if not there already in a few names. But in terms of the stocks themselves, there were some volatile moves. I guess A2 is always a big mover on its result days, and this time was no exception. We saw it down 21% on the day, which was surprising in terms of its result itself. For the infant formula manufacturer, it actually had an okay set of numbers in line with its prior guidance, so no surprises there. Where it came unstuck was on its outlook. Again, there's a few issues there, one of them being around its margin assumption for the year ahead, which was flat. Now, in general, the consensus was for a decent uptick, partly through to some of their loss-making businesses doing better, which is the US and their MVM facility down south. But unfortunately, that wasn't the case. It had some supply issues through one of their largest suppliers, and hence the flat margin was almost like a 10% miss in terms of earnings for the year ahead. So the stock was indeed punished. Now, it is a stock with strong cash balance, and we'll actually see what happens in the year ahead. We're likely to see it put to work through managing some of its supply chains, likely to acquire or invest. And as we've already seen with Synlait, are looking to resolve the capital structure there with them and Bright Dairy putting money in. That certainly secures supply for them for the meantime. But the big piece really is around their future pipeline of China label product from formula, and that's something they yet to solve in terms of licenses. So look to see some activity there as they track throughout the year. Another disappointing one, unfortunately, was Spark. Now, both Spark and A2 have been underweight, so it's actually been helpful for us. But Spark was a miss. They did a downgrade earlier in the year. They're sort of seeing weakness in their IT business, whether it's through enterprise or government work. We've certainly seen a slowdown, and no doubt we've seen that in headlines from government pulling back spend. But even in mobile, sort of weakness in connections as well as ARPU's not quite coming through at the strength, and this really does swing a result. But in terms of overall, weak free cash flow outcome for the business as well. And I guess when we're looking at the dividend, which is a key part of Spark's investment thesis, really, it's just how sustainable is the current divvy, which has recently been increased, and they're just not at a stage where they're paying it through free cash flow. So for us, with the balance sheet that's a little bit overgeared versus the debt rating they're targeting, just looks a little bit challenged for now, and the market certainly thought that too, with the stock trading off pretty aggressively. I actually got the joy of seeing one of their new data centers recently, so that is an area of growth. Dare I say, a smaller area of the total business, but there are some green shoots there. But at the end of the day, I think the market needs more certainty around its free cash flow rolling forward. One that did surprise to the upside was Chorus. And again, probably one again where the result was in line, no big surprises there. But where the beat was around its dividend, well ahead at 57 cents. The market was 10 cents or so lower. And that was, as I said, 14% ahead of consensus. Now, as rates start to fall, dividend yields are a pretty keen piece of the market, and the market certainly rewarded the stock up 10% on the day. So it's, from our view, what changed from Chorus and where do we maybe get that one wrong, which is really around the board's confidence on its ability to pay out its dividend from here. They've certainly pulled back capex on some of their less certain projects. And again, with the Commerce Commission, just a bit more certainty around the outlook. We still think there's questions around how sustainable that dividend might be in the longer term, in terms of as their regulated asset base shrinks. But it's one we're keeping a close eye on. Now, I guess one of the ones that's been in the media a lot is the gentailers, and this is around power prices. And we've seen the full circle of that from $1,000 power prices through to $1 power prices last week. So it's been volatile. In terms of the industry, we did see results across all the big names. It's been really interesting to see and talk to the companies around how they are performing. Some of them, while they do benefit from the higher prices, have actually locked in a lot higher costs as well associated with this through gas and lack of gas in the market. We saw a deal with Methanex for a couple of the providers there. But also, when you do look at their historical returns, I think they're, you can see that someone like a Contact or even a Meridian, the return on invested capital over the long term is still low single digits, 4 or 5%. So while we can see some sort of high earnings numbers in the current years, don't forget there's a lot of capital at play, and certainly as we move to a more renewable grid, there's a lot of capital being put to work as we're seeing. So it's interesting to see how that tracks for now. But we know that obviously the government is keeping a close eye on the sector, doing their own review. Our view in general is that we don't expect anything major untoward to come from it. Obviously, there's a lot of talk about an LNG terminal. So there is some sort of solutions for what might be dry year risk in the future. But in general, we think it's a sector that continues to do well, and partly from higher electricity prices, but also from just the development and the market share that the main names are going to have. Just a quick one on the month ahead. Obviously, retail and a few of the agri names out. We'll be interested to see how the consumer and New Zealand Nick is performing. So we'll look forward to updating next month. And I'll now pass you over to John for the Trans Tasman Fund.
Thanks, Dave. Yeah, looking towards Australasia. It's a solid performance for the fund. We delivered a sort of a month touch under benchmark in what were pretty volatile markets. We're the right side of most results, as Dave's highlighted. The underweights in Spark and A2 worked well for us, as did the overweight in FBH ahead of its trading update. I think it was a reasonably difficult reporting season both sides of the Tasman. And certainly, we were expecting a solid 2024 and soft outlooks, and that was very much delivered. The slide on the right highlights how the ASX 300 fared in terms of earnings going forward, and there's very little sort of positive. The market in general is off about 3, and obviously things like energy and utilities had quite material downgrades. But difficult markets, and a number of stocks were off 10 to 20%. Unfortunately, we owned one of them, which was Megaport. To be honest, their result was quite frustrating. If you looked at the 24 result, it was in line with expectations as we had expected. The FY25 guidance was also conservative as expected. And they did highlight a number of new customer wins over the last 12 months, which sets them up reasonably well for the future. Also, there were signs that the new management team were actually delivering on their sort of quest to make the business more scalable. And, certainly the sales guys that they've added over the last 6-12 months were generating new customer wins. The big problem for the result really was that, the older sort of customer base continues to churn. And while the company was at pains to point out that the numbers of those customers leaving Megaport hasn't increased, it feels like the value of these customers has. And clearly, if we have customers churning, that does create a headwind going forward to the earnings. And the reality is we need to get a lot more confident about, why they're churning and whether that churn is abating or starting to abate before we get more positive on the stock. So, a combination of Megaport and a more bullish dividend from Chorus were the reasons why we traded broadly in line with the market. And during the month, we continued to add to positions such as Ryman, Stride, and James Hardie, while exiting things like Cleanaway and Macquarie, which had basically hit our price targets, and selling a bit more Goodman Property Trust. Moving across to the property fund. Again, a very good month for property, second month in a row, basically driven by the macro, more dovish comments about interest rates and expectations of cuts going forward, albeit more in New Zealand and Australia. We did get a few sets of results, Precinct, PFI, Vital Healthcare and Winton, as well as a few Aussies. And for the most part, the results are actually quite solid. Couple of pockets outperformance, which I'll come back to. Mainly Charter Hall was a very good result. And in general, I think during the month, those names with exposure to office and retail assets, which have been under a bit of pressure, tended to fare better, as did those with more debt on the balance sheet, while the safe haven industrial assets were used to fund the move of the former. I suppose the key message I took out of the reporting season was that management see the dividend as a very important part of the investment return, and will do pretty much everything to maintain the dividends where they are. And so, the reality is, I think the risk of dividends cuts is reducing, if not gone. Clearly there is still earnings headwind from higher interest costs to be paid in 2025, but I do think that the sort of prospect for dividends is now probably improving. Looking at a couple of the results during the period, probably Charter Hall was a standout and benefited quite well from owning it. Again, solid result in line with expectations, with earnings of about 75.8 cents, a couple of cents ahead. In reality, there was a bit of write down and a few divestments, but the key going forward was that the outlook for 79 cents of earnings was probably 4 or 5 cents ahead of where consensus thought it would be. And the implication, or the strong implication from management, was it was the trough of the cycle. So, the stock performed pretty well on the back of that. One of the names which didn't fare so well was Goodman Group. I mean, it does feel like we are probably past the peak in sentiments towards AI and data centers, because the Goodman result was fine. They delivered 14% growth in 2024, guided to 9% for 2025. But I think the market was hoping for a couple of new contracts with hyperscalers, and for a stock which is up sort of 66% in the last 12 months, that wasn't enough and caused a bit of a sell-off. Big picture, it's still a high quality business with a lot of growth, and we're still happy with it. I suppose I'd finish with a bit of sort of positive, or a bull case for the property sector. The chart on the right is sort of another interpretation of what we've been talking about in terms of term deposits and yield-heavy sectors. Essentially, that the deposit balance has got pretty high. The interesting thing going forward is if we do see rate cuts, and again of the ilk of the 100 to 150 basis points over the next 12 to 18 months, then the yield offered by an equity and the property sector will be higher than a bond yield or what you can get in the bank, and I think will become much more compelling. Clearly, the magnitude of that deposit balance, if it were to go into the NZ REIT sector, would be a massive inflow, which would clearly benefit, the whole sector. I'm not saying that that's going to happen, but clearly, if we do start to see some of this, deposit balances or term deposits coming back towards the sectors which offer decent yields, of which the property sector is one, that could have a material benefit to the sector overall. Just finish by saying, over the period, we did sell out a little bit of more of our defensive assets. So we sold a bit of GMT and a bit of PFI and took a bit of profit in NextDC. And then we added to holdings and things like KPG and Stride, which we continue to expect to benefit more acutely from the rate cuts going forward. Anyway, that is a wrap for the month, which was August. As usual, thank you very much for your support. We will speak to you in a month's time or so. But in the meantime, if you do have any questions, please drop us a line at info@mintasset.co.nz. And we'll speak in a month.